This conference will now be recorded.
Hello, let's talk about long-term care. All right. You need to know the definition. Long-term care is a program that's designed to provide coverage for diagnostic, therapeutic, rehabilitative, maintenance, and personal care services in a setting other than an acute care unit of a hospital. When you see acute care, they need a high degree of medical attention. That's your health insurance providing that type of care. But should you get out of the hospital and can't quite do things on your own, you might have to go to a nursing home till you can recover before you go home. That's what long-term care provides. It basically complements your health insurance at any age. And you can purchase long-term care as an individual policy. It could be a group certificate, maybe an employee benefit, or typically it can also be purchased as a rider, not typically, I should say. You can purchase it as a rider added to a life insurance contract or even an annuity contract. Some companies do offer that now. So when you're thinking of who you should market to, you don't really need to go for high-income people. So for the exam, keep in mind this is for the test. Right? Your target market is not high-income people. Someone making $300,000 a year has over $2 million in assets. They can afford to hire someone to take care of them. All right, so it's not your target market. You don't want to deal with low-income people, people that don't have a lot of money. And if you got to make a choice between paying your utility bill versus buying a long-term care policy, not the target market. Okay, number one, you're so close to spending down to Medicaid or Medi-Cal, and Medicaid or Medi-Cal covers that long-term care need. Okay, so it's not high income, not low income. You're looking for middle income, upper middle income. Someone who's got $60,000 a year and about $200,000 in assets. They cannot afford the care. They don't want to spend down, but they can afford the premium to preserve and protect what they have. I mean, I'd rather pay $5,000 a year in premium versus $8,000 a month in benefits because I didn't have a policy in place. And that's how you want to view that. All right, so middle income, upper middle income, that's your target market. Keep that in mind when you're taking that test. As far as types of policies, the general classifications, we have tax qualified, which is federally regulated, and we have non-tax qualified, which is typically state regulated. All right, both of them have activities of daily living or ADLs. The federally regulated program or tax qualified program has 6. Right, now, let me explain the tax qualified. It's pre-tax premium with tax-free benefits. How cool is that? Okay. So there's 6 activities of daily living: ambulating, bathing, continence, dressing, eating, and toileting. Right. Another trigger for benefits is cognitive impairment. That's the inability to perceive or remember Alzheimer's, Parkinson's. That's how you want to understand that. Okay. But you have to be cognitively impaired for 90 days on the tax qualified program. Now on the state program, the non-tax qualified program, it's going to be after tax premium and tax-free benefits stuff, right? But there's 7 activities of daily living, right? Ambulating, bathing, continence, dressing, eating, toileting. Transferring, you're noticing, is on the non-tax qualified program versus on the tax qualified program. Transferring is going from a laying down to a sitting position or a sitting to standing position where you might need some help. That would be a trigger. Now, it doesn't matter whether there are 6 ADLs or 7 ADLs. The magic number is 2. If you cannot perform 2 of the 6 ADLs on a tax qualified program or 2 of the 7 ADLs on the non-tax qualified program, that would be a trigger for benefits. Right? Another trigger on the non-tax qualified program, cognitive impairment. Again, the inability to think, perceive, reason, and remember. That's Alzheimer's, Parkinson's. Keep that in mind. But you don't have to wait 90 days. Once you're diagnosed, that it can actually trigger your benefits right away. So I'm not sure if you're picking it up, but the non-tax qualified program is a little more liberal as far as benefits being paid. The tax qualified program is a bit more restrictive. That's not really on the test, but in the real world, if you want to do a comparison, take a look at the ADLs and look at the definitions. Right? On the non-tax qualified program, if you have trouble picking up a utensil and manipulating food, that means picking up a spoon or fork and moving food around your plate and getting it to your mouth. If you can't do that, you're going to need some help. That would be the eating activity, daily living. Right? On the tax qualified program, if you can still take food through a straw, a feeding tube, or intravenously, then you wouldn't qualify. So it's a little more restrictive. just to give you a heads up. But you got to know a bit of the difference when you're out there selling. As far as policies, you can purchase it as institutional care, being in a facility, right? Or you can purchase the home care policy, able to be at home, having friends and family take care of you. Now, you can buy those separately, or you can combine them, which is the comprehensive long-term care policy. So comprehensive long-term care covers institutional care and home care on one program. Now, on the home-based program, the home care program, we have these items here: adult daycare, hospice care, respite care, personal care, homemaker services, and home health care. Any home care policy or home-based care policy must include those 6 items, right? Adult daycare. Well, think of daycare for kids, where you drop kids off at daycare so you can go to work. Well, let's change that around. You're dropping your parents off at daycare so you can still go to work, right? Because someone's got to watch them. That's how you want to understand that. Hospice care, you definitely will get a question on this, is for terminally ill patients. It's typically a facility designed to control pain and suffering for terminally ill patients. They don't treat diseases or attempt to cure anything you have. They just dope you up with painkillers to help you die with as little pain and suffering as possible. Hospice is like a final hotel stay. Right? Some people call it heaven's waiting area. Right? There's no treating to get better. There's no rehabilitation. This is making you comfortable for your final days. Okay. Respite care. That's giving the daily caregiver a break. So let's say you're taking care of one of your parents at home 7 days a week, 24 hours a day. Would you like a break? Maybe send them to a nursing home for a week to 2 weeks so you can have a break. That's what respite care is, giving the daily caregiver a break. Personal care, that would be you need help eating, dressing, bathing, doing normal routines of everyday life. If you have severe arthritis where you cannot button your shirt, that's what the personal care is. A lot of times it can be provided by family members and friends. That's the unskilled care. Right? Homemaker services, that would be the cooking and the cleaning. Home care services, that would be occasional visits from a home health aide, maybe coming out, administering some medication, maybe a brief bout of physical therapy, and that's basically about it. Okay, but those 6 items have to be part of a home care policy. Right? The institutional care, people always associate it with that skilled nursing facility, 7 days a week, 24 hours a day in a nursing home. Right? And there's some other facilities also associated with that, where you're in there typically 7 days a week, 24 hours a day. Right? Now, you're going to choose a daily benefit at the bottom here. Right? So when you see a daily benefit, you're going to pick a daily benefit, or you're going to buy a daily benefit. So let's say you bought a $200 a day daily benefit. If you have this comprehensive long-term care policy, if you bought a $200 a day daily benefit on the institutional care, the home care policy must at least pay 50% of that daily benefit. Right? So if you had $200 a day here, but you're not in a facility, but you're able to be at home and you do need that care, this will pay you $100 a day, 50% of that daily benefit. Okay? So always remember, the home care payment is 50% of the institutional care benefit. Okay? The periods of time, not just periods of time, but how long do you want to pay premium? I mean, if you have a lump sum of money, right, just single premium buy this policy. If not, maybe do a limited pay. How about these scheduled premiums where you pay for 10 or 20 years, and then after that you can stop? Or did you want continuous premium? You sign up for this program and you pay premiums for the rest of your life, okay, until you die. And so whichever option fits in your budget is fine. It's kind of like buying a new car. You want to pay cash for the car, you want a 2-year loan, or you want the 5-year loan. It doesn't matter how you pay for it. It's the same car. So with this one, it doesn't matter what how you pay for it. It's the same policy, and you're choosing the benefits you want on the policy. To help with getting a lower premium, you can raise your elimination period. So the short elimination period is 30, 60, maybe 90 days. If you go into a nursing home, you have to cover the first 90 days before the insurance kicks in to cover the nursing home stay. Right? You can even extend it. Maybe you want to cover the first 1 year or 2 years in a nursing home. Right? So again, the elimination period is like a time deductible. By raising your elimination period, you're going to lower your premium. right? So if you want a longer elimination period, that means you're going to pay more of the claim when the loss occurs, or should a loss occur, and then have the insurance kick in after that. Now, by raising your elimination period, saving money, then you can get maybe a longer benefit period. Right? The minimum benefit period for any long-term care policy is 1 year. That means there's no such thing as a 6-month benefit period on a long-term care policy. It must at least cover you for 1 year. Right? You can get a 2-year, 5-year program, or even lifetime benefits. It's up to you. You can change the daily benefit also. That's another option that you have. Right? $50 a day, $200 a day, or up to $500 a day. Even more. Sometimes you can even choose more. But again, the greater the benefit, the higher the premium. Right? So again, to offset that, maybe you want to raise your elimination period, the money you save, cover you for longer time limits, and give you a higher daily benefit. Right? So those are some options that you have. Some other things to know: waiver of premium. So if you did file a claim and you go into a nursing home, right, you'd still have to pay the premium to continue the coverage. And so with a waiver of premium, if you're confined to a nursing home, they won't basically waive your premium. Your policy still continues while you're in there. The reason we have this is you might get better, you might come back out. Okay, that means you still got to pay the premium. But yeah, when you come out, you pay the premium. But while you're in there, you wouldn't want to pay the premium at the same time. Right? Inflation protection. This is a cost of living rider. In selling long-term care, you are required to offer inflation protection. People don't have to take it, but you got to offer it. And if they're choosing not to take it, you make sure that they sign off that it was offered and they're choosing not to take it at this time. All right, so that's a cost of living rider. A free look period. Well, typically in life insurance and health insurance, the general free look period is 10 days to 30 days. If you're a younger person, 10-day free look period. Anyone 60 years of age or older automatically get a 30-day free look period. But with long-term care, you automatically get a 30-day free look period regardless of your age. That means if a 22-year-old happened to buy a long-term care policy, they have a 30-day free look period, right, just so you know. Downgrading. Well, let's say you bought that comprehensive long-term care policy, and with a little bit of a fixed income, it's kind of getting out of your budget. So you can downgrade, you can drop it down to an institutional care only or maybe a home care only policy. And that is allowable. You can downgrade it to cut your costs, right? And choose which one you want. HICAP, Health Insurance Counseling Advocacy Program. In California, we have these facilities. Basically, it's a toll-free info line. And we do have offices throughout the state. It's a toll-free info line for seniors to call if they have any questions regarding senior health coverages, such as Medicare, Medicare supplement, senior HMO, and of course, long-term care. It's, like I said, it's toll-free. So there's no charge. It's not based on ability to pay. There's actually volunteers that are highly trained, right, and educated that provide information, and they help people with any questions they have on senior health coverages. They do not provide medical assistance. It's not a 1-800-ASK-A-NURSE. They can actually assist with claims, though. That's the advocacy part. Right? But it's a toll-free info line for seniors to call if they have any questions. In the life and health world, this is the only required 800 number that you have to present to your prospects, your clients. Okay, anyone that you're selling senior products to, you have to provide this toll-free 800 number for them to call. All right, conversion versus continuation. If you're with a group insurance program, right, and you leave the company, you can either convert it to an individual policy. Right? So you're leaving the group program, converting to an individual policy because you left the group, and you got to take over the premium. You can convert your group insurance program to an individual policy within 31 days. Right? No medical exam. Continuation is like COBRA. So you're on a group insurance program, you leave the group, you can continue the same benefits you had as a covered employee, you just got to pay the premium. Okay? Some companies will allow that. A lot of companies are sending me a conversion. You leave the group and convert it to an individual policy without a medical exam. Okay? Guaranteed renewable versus non-cancelable. Long-term care, most policies are sold as guaranteed renewable. That means as long as you pay the premium on renewal, then you're guaranteed to renew. No medical exam at all. All right. Now, the downside of guaranteed renewable is, let's say it's a 5-year guaranteed renewable contract. That means you buy this policy, in 5 years, you can renew. You're guaranteed to renew, but you're now 5 years older. And so the cost is going to go up. And 5 years after that, your rates will go up again. So for every renewal as you get older, you have to pay the increase in premium, but there's no medical exam. So most people buy guaranteed renewable contracts for long-term care. Number one, it's got that word guarantee in it people seem to love. Number two, initially the premiums are cheaper. But with all things being equal, you should recommend non-cancelable. Now, non-cancelable is going to be a little more expensive up front, but your premiums remain level. No premium increase. With both guaranteed renewable and non-cancelable, the insurance company cannot change the term, the benefits, or rights of the policy. You pay the premium, you have the coverage. But do you want increasing premiums as a senior citizen, or would you like to pay a little bit more now to have level premium from here on out? That's a choice you're going to ask your question, a choice you're going to ask your clients on what they want to do. Okay. If you didn't buy a long-term care policy, your options are, well, move in with your friends and family. You can have them do that. Self-insuring. A lot of people actually do still self-insure. Right? A lot of other countries and cultures, they take really good care of their elderly. Right? Unfortunately, out here, some people, they really don't. Okay. And so, but you can choose to. Or if you use up all your assets, that's the self-insurance part, you might spend down to the social program. That would be Medicaid or Medi-Cal. That's the low income or no income program. That's Medicaid. It's called Medicaid throughout the nation typically. Here in California, we have Medi-Cal. It's our version of that same Medicaid program. It's for medically needy, medically indigent. Right? So people that are basically broke, cannot afford it. The federal and state government work together to provide this socialist type health care for people who need it. Right? And also there's the Veterans Administration for military personnel. The downside of that, there's a waiting list, right? First come, first serve on that. But the Veterans Administration does provide some coverage also. Okay, so those are your alternatives. So always remember that your long-term care policy supplements your health insurance coverage, doesn't matter your age. Right? Not that a 22-year-old would buy a long-term care policy, but they could. Because if they got into a serious auto accident, they're released from the hospital but can't do things on their own, they may have to go to a nursing home. And unless you have a long-term care policy, you're paying for that nursing home stay out of pocket. Right? And again, remember that long-term care does not cover acute care. That high degree of medical attention that's provided in a hospital, and that's your health insurance. So this complements your health insurance at any age. And with that, thank you very much. If you have questions, go ahead and reach out to me. Good luck in your studying.